question is, why did the war stop?
Welcome to Landlords and Tenants, What to Know and How to Win, with your host, attorney Niv Davidovich. In the Landlords and Tenants podcast, you'll learn from property owners as they share their experiences, aimed to help shape and educate people's practices. What has worked, what has not worked. You can find this show on all the major platforms, including YouTube, LinkedIn, Facebook, Apple Podcasts, Spotify, and on our website, davidovichLaw.com. Now here's the host of Landlords and Tenants, Niv Davidovich.
Hey, what's going on, everyone? This is Niv Davidovich. Welcome to episode 3 of our podcast entitled Landlords and Tenants, What to Know and How to Win. I'm hoping to provide our audience with helpful tips, insightful war stories, updates on the law, and also unique perspectives on the real estate industry, landlord-tenant relationships, and I'm hoping some entertaining stories which should assuage you that whatever your landlord-tenant nightmare might be, trust me, somebody has it worse. Today, my guest is a great client and longtime player in the real estate games, Larry Jacobson, president and CEO of Jacobson Equities. He's a veteran real estate investment firm. Jacobson Equities, formerly the Jacobson Company, has been around for more than 50 years and currently has at least 9 featured communities representing large multifamily housing projects across the country, amongst other various holdings. Larry has also been a real estate attorney, practiced at Buchalter, Nemmer, Fields & Younger. It's a very prominent Los Angeles law firm where he represented a broad array of institutional, entrepreneurial clientele, developers, owners, investor groups, lenders. Larry's also worked with a lot of other property types, so multifamily, office, retail, golf courses, studios, mixed use, and fun aside, Larry was also the general manager and partner in Giant Records prior to its sale to AOL Time Warner and second in command at Capitol Records. He is the owner of artist management company World Audience. First, Larry, thank you so much for coming on the show. It's a real honor to have you here. I really appreciate you taking the time.
It is my pleasure, Nick. I always love talking to you.
Oh, thanks.
Although it can be depressing sometimes.
Unfortunately, I have to tell the truth, and a lot of the times, the truth here in Southern California when it comes to landlord-tenant law is not always fun. But it is what it is. So I think the thing that a lot of people, or at least most people, are interested in is what's your story? How'd you get into real estate? I know your dad was in the business. He started the firm. Can you tell us a little bit more about that?
Sure. My father was one of Southern California's most prominent real estate figures. He started a firm called Wagner Jacobson back in the 60s, which at the time was the first and for many years only and largest apartment house brokerage firm. So it used to be that somebody who would sell you a house would also sell you a duplex. And my father was one of the pioneers in specializing in apartments. He lectured a lot. He wrote a book on tax deferred exchanges. He was the president of the LA Board of Realtors, which is now AGLA. And he started syndicating in the late 70s. They did a couple of syndications. His attorney at the time was Sam Freshman, who was really recognized as sort of the dean of California syndication. And he persuaded my father to start syndicating. So they syndicated a couple big deals down in Orange County, one in Newport, one in East Costa Mesa. And then in the early 80s, he left, went out on his own, and he started syndicating exclusively. And he was one of the earliest investors to go up into Sacramento. The Kings had just gotten there. I mean, it really wasn't a market that people were as actively buying in when it came to apartments. And then over the years, he developed a few deals and throughout the Bay Area and Northern California. I took over when he passed away in 2012. And I'll tell you a little bit about my story, which was that I had graduated from USC Law School. I went to UC Berkeley for undergraduate. I went to USC Law School. I graduated in 1988, and I went to work at Buchalter, Nemmer, Fields & Younger, as you pointed out, as a real estate lawyer. And I thought that, because I was at home and there were a lot of dinner table conversations about real estate, that must be something that I enjoyed. And it was a very good experience if you think about the timing, right? So you're really dealing with, the end of the 80s. There's, we were doing multi-state leveraged buyouts and a lot of really exciting deals. And then, of course, savings and loan crisis happens and you have the RTC. So now there's a lot of workouts. I had an opportunity to see a lot of very interesting transactions, to participate in them, to learn from doing them and so forth. I also thought it was really boring. And I was trying to figure out, should I go to another firm? But the firm itself was great. That really wasn't the problem. And I ended up deciding what I really loved was music. So I ended up getting into the music business. And I started out as the number 2 lawyer at a company called Giant Records, which was a joint venture with Warner Brothers Records. And a gentleman named Irving Azoff, whose name you undoubtedly know because he was the manager of the Eagles and Steely Dan, and then he ran MCA, and then ultimately Live Nation and Ticketmaster. And he's arguably the greatest manager who's ever lived. Eventually, I brought in some successful records, including the soundtrack to the movie Dazed and Confused, multi-platinum, and the follow-up to it, which went gold. And eventually, I rose up to run that firm and be a partner in it, minority partner, of course. It was sold to AOL Time Warner. It was sold back into AOL Time Warner when the two companies merged.
Right.
And I left. I went to Capital. I was the number 2 executive there. And then I left and started my own management company. And over the years, I'd managed one band in particular I was associated with that was living with their parents at the time I met them in 2002. And I thought they could be a really big hard rock band. And now they are one of the biggest hard rock bands in the world. They're called Avenged Sevenfold. And we had a great experience for 20 years. I managed them. And over the years, I've also managed Alanis Morissette and Michael Bolton and Slash. And those were all, fine experiences, but not as much. I really didn't love managing anybody as much as I loved managing Avenged Sevenfold. As I mentioned, in 2012, my father got to the end of what was a 6-year fight with multiple myeloma. And at that point, the music business had gone through a lot of changes, as you know, through the move to first to downloads, to digital downloads, and then ultimately to streaming. And I decided to take over the family business. I had been groomed to do so back in between when I graduated from Cal and before I went to law school. My father, even though I went directly from one to the other, my father, when I graduated, said, "I want you to manage some of the family's buildings in Los Angeles so you learn the family business." Mm-hmm. There was no Yardie. There was, a notebook that you walked around, collected the rent, and you went and spoke to the managers, and you paid the expenses, and then you wrote it all down by hand. But it gave me a lot of firsthand experience in the experience of how to run a building. And then when I was a young lawyer, I became his co-general partner in some of these deals. And obviously I'd had a lot of, sophisticated business experience. So when he got to the end of his life, I looked at the business that he built, and it was really it was a fantastic business because of one thing, and that was people trusted my father. Syndication, as you may know, was, and it still, frankly, sadly, to some extent now still is, sort of a fly-by-night business. There'd be a sponsor who would go out and reach out to a bunch of people and persuade them to give them money, and then they would invest it. But you have some people who are just not savory characters, and then you have other people who are just not experienced real estate operators. Right. And my father was somebody who was both. He was trusted as a from an ethical standpoint, and he was trusted and experienced as an operator of real estate. And so as he got to the end of his life, he had hundreds of investors, maybe about 500 or so investors, and they'd had a uniformly positive experience with him. And I felt that taking over that business and expanding it in several ways, which I'll talk about, was something that made sense. So first thing that I did was we started adding investors, and it won't surprise you to learn that a lot of them were in the entertainment business.
Right.
My sister is a producer. She produces The Hunger Games and Crazy Rich Asians and a lot of other TV shows. So we had deep roots, as anybody who's grown up in this city often has, other people, including the girl who grew up in the bedroom next to you, right? They go into the entertainment business, right? Because it's a company town that way. So we have a lot of business managers who put in their clients into our deals, actors, recording artists, agents, lawyers, and so forth. We have a lot of high net worth clients that we added to the fold, and other RIAs and so forth put money into our deals. So we added a lot to our investor pool. We also decided to go outside of California. Before that, we were exclusively in California, Southern California, Northern California. And we decided that there were other markets where we felt there were opportunities. There were other markets where we felt that the job growth, population growth, supply-demand fundamentals, and just sort of a supportive regulatory environment were in many respects as or more favorable than California. Obviously, depends on the particular issue. So we started buying in Washington, Colorado, Texas, and then also in Florida. And we ended up also expanding into student housing. So I have my overall way of looking at the world is I get a little smarter every day in apartments. So we don't really go outside of our sort of core competency. But student housing, though it has some unique differentiators, particularly the lease-up period, which takes place in the first 6 months of the year, give or take, hopefully. And then obviously the turnover period, the period during the summer. I mean, those are obviously unique to the asset class, but they're not dramatically different. At one point, I thought maybe I would get into senior housing. And that was really more like running an operating business on top of a piece of real estate. It was more like a really highly specialized hotel. So that felt like we would be outside of our expertise. And we feel like, when people come to us, they really are betting on our knowing how to operate a business, how to identify a good piece of property, and how to run it well. So anyway, long and short of it is we started expanding into student housing as well. And the business is now, bigger, and we have a lot more investors. And I'm proud to say we still have many of my dad's investors. We have their heirs in a lot of cases because their parents told them, whatever you do, listen to Jacobson and stick with them. And for the most part, they have. We're proud of that. And it's
one of the investors.
Well, and we're grateful to have you. We're grateful to have you. I mean, obviously, that's the highest form of compliment, right? That somebody who has an opportunity, as you have, working with us, to sort of see underneath the hood, likes what you see. And that obviously means a lot. So anyway, so that's where we are.
That's amazing. It's a really, really amazing story. Not a lot of people have that sort of history and those roots. So it's fascinating. You mentioned that you know how to identify a good piece of property. Tell us about your process. How do you differentiate the frogs from the princes?
Well, I love the way you put it too, because we definitely kiss a lot of toads, and we are, and to mix metaphors, and we're also the bridesmaid, not the bride at most of the deals. Or to mix it even further, we get to the 1 yard line, and then we say we're not going any further from a pricing standpoint.
Right.
So I think it starts with the market. You really have to feel that there's a compelling reason why you want to be in that market. And we can talk about California, because California is interesting. It's got a lot of, a lot of problems, but there's also some compelling aspects of the state, which is why we still invest here, and we still believe it's a good place for investors to put their capital. But what we really are looking for is pretty simple. Does somebody want to live there? It's not that hard of a calculus. It's not that hard of a business. We can talk about that more later, but we're really looking, do jobs want to be there? Or do employers want to be there? Are they moving there? Do people want to live there? What is the cost of housing relative to what people make there in terms of their income. What's the crime like? What are the schools like? We're looking at, again, California doesn't win in this respect, but we're looking for a supportive regulatory environment.
Right.
Texas, the Florida, we're not really buying more in Florida. That's unique because we own a large 618 bed complex that brand new that's across the street from the University of Florida.
Wow.
But that's we don't really focus on Florida. The distance is part of it. That's not really the issue. The real issue is the insurance at this point, which, as you know from your other clients and business associates, it's insurance is really a topic du jour right now.
Florida is, people are telling me that Florida is the one place that's even crazier than California.
Yeah. I mean, Dallas or Texas in general, has its issues. And I have reason to be somewhat optimistic that I don't know that we're at the peak, but that we are about to peak in terms of where costs are going, just in terms of some very anecdotal evidence that we're hearing. Too soon to tell, but just the beginning of the year, the people who've gone through their renewals so far, you're not seeing some of the really big increases. Some people are going to go through it because they haven't improved or increased their stated values. What it costs or what they say it costs to replace their property. But once you've done that, you've taken out some of the pain out of it, right? Because at that point, the big jumps should be less necessary.
So tell us a little bit about that, because that's a question that a lot of my clients have: is how are you getting the insurance companies to not give you a huge raise?
Well, I think there's a few things. To some extent, you can't completely control it, right? The industry makes those decisions based upon what you're seeing with climate change, right? So you see Hurricane Ian and the cost to insurers from that. You look at the Texas freeze and what that cost insurers. You look at the wildfires in California. Those are all things that go into the process, But you also have the reinsurance market had really retracted in the last few years. I'm told, I'm not an expert, that it has gotten better this year. Which obviously makes a difference, creates more competition for premium dollars. So that's certainly one thing. Obviously, having a good loss history is important. That's you really obviously want to avoid claims, either property claims or liability claims, to the extent that you can, and that's to some extent a function of how you operate your buildings. It's not exclusively, right? There's also just luck plays a role in it. Where you buy can make a difference. We do own in Denver, which has wind hail issues. Dallas, which has wind hail issues. So you don't want to let it be the tail wagging the dog. You don't want to buy in certain places, or avoid places you think could be really good from a lot of other perspectives. But it certainly can be a factor in it in terms of what it costs per door. To insure something. But then the issue that I brought up a few moments ago, which is stated values. So, part of any insurance program, and we have a master policy that insures all of our assets. Part of that is, well, what are you saying it would cost? Or what are you, the insured, saying it would cost to replace your property should there be some sort of a disaster? In the past, people would represent their values to be on the low end of the range, and insurance companies felt that they were understating what it would cost to replace a property should it burn down or have some other damage, and that as a result, it was costing the insurance company more to replace it than they had collected in premiums. As those had been increased by however they invest their money and so forth. So they've now turned to insureds and say, you need to get these values up to where we're comfortable. And the thing about that is it can be painful from a premium standpoint at first. Well, it's always painful, right? Because you're raising the bar. But once you've raised it, your increases are going to be more incremental. once you sort of take that pain or swallow the frog, as it were, when it comes to that initial period where you want to get your values up. None of these are fail safes. It's a very difficult environment. But the combination of, again, what I'm hearing is a healthier reinsurance market, getting your stated values up, running a building in a way that you minimize the damage and take care of your properties, you take care of your tenants, and hopefully you bring in good tenants. You should be able to start seeing them level off some. I think. I don't have a crystal ball.
Right. That's great advice. So you mentioned offline that you're raising a fund. Can you tell us a little bit about that? What sort of opportunities and challenges you're facing with that? Why you decided to raise it?
Right. Well, there's no challenges. We think this is a tremendous opportunity that investors face, an extraordinary opportunity. There's $1 trillion in multifamily loans expiring over the next few years, and they're not all going to be able to be refinanced. A lot of them were high leverage. A lot of them were floating rate debt. Their caps have or are expiring. Values have obviously not kept pace with what they were, simply because interest rates have gone up so dramatically. So as a result, there's going to be a lot of opportunities out there to buy good properties, really good properties, at a substantial discount to replacement cost. And our model, as I mentioned, has been syndication historically, and that's been fine. But the negative of it is we turn people away on every deal, and we feel that we are embarking on such a rare opportunity to buy great property that this is the time to change the model and to enable our investors, to have the dry powder that will allow us to take advantage of as many opportunities as will present themselves, and not be asked to either be unable to invest or to have to cut back, because that also happens even with some of our high net worth investors or higher net worth, where you turn to them and they want to put in $1 million and you can only take $500,000. So you want to be able to offer these people the opportunity, offer your investors the opportunity to take advantage of this extraordinary time to buy real estate. And you're really, the way we look at it is, your base case is buying assets not only at a higher cap rate than was the case several years ago, but you're buying at a time when NOIs have flattened, in some cases gone down. So you're capitalizing a lower net operating income, which creates a more compelling price for a lot of really good real estate. It's not all going to be good real estate, because in a lot of cases, it's not all going to be acquirable, but depending upon who the lender is and so forth. But a lot of what was going on was, this the old joke about the sardines. I sell you a can of sardines for $1. You sell it to your partner for another $1. He sells it to his friend for another $1, and then his friend sells it to another friend of his for another $1. The last person takes it, opens it up, takes a bite, and says, "My God, these sardines are disgusting." The guy turns to them, "Those sardines aren't for eating; they're for selling." So that is that's what we saw a lot of in the last few years. A lot of people, oftentimes syndicators, buying properties you didn't necessarily want to hang on to for the long haul. The thesis wasn't, "My God, people want to live here. This is a really compelling place for somebody to live," both in terms of the community, the micro location, as well as the property itself. What you would see are people who were buying properties under the premise of, put down very little equity. We'll assume that we will either be able to refinance it and or sell it within 2 to 3 years. And then that's not a bad strategy until it's not a good strategy. And it works until it doesn't work. And obviously, once the Fed started raising rates in 2022, that made a huge difference. So not all those properties, some of those properties are going to be that proverbial can of sardines, and you're not going to want to own them, but there's going to be a lot of really good properties out there. So base case to us is there's going to be an opportunity to buy really good properties at just a discount to where they were trading at a very reasonable price, which is just by definition is going to mean you're acquiring a quality asset with with reduced risk. And to us, risk-adjusted returns are everything. We really believe, we never took on too much leverage. We did have some floaters. We've sold or swapped them at this point, but we typically are a fixed rate shop, and we're a lower leverage shop. We're not at 75, 80% or more or worse. So, and we think there's also going to be opportunities to buy directly from lenders in terms of REO. There may be some other opportunities as well. I was in New York all last week at a distressed debt conference. And so this is where we believe, we think this could be another RTC type moment. And so we are preparing. We're loading up, as Warren Buffett would say, the elephant gun, because we think there are going to be some opportunities, and we want our investors to be able to take advantage of them, and the fund allows them to do that.
Do you see, I know this is not necessarily your field, but do you see similar opportunities that are going to come around in other areas of, say, commercial real estate, retail, storage, things like that, industrial?
I really can't speak to, to some of these other asset classes because I'm not as conversant in them. I would say this, office is unique because office has gone through a secular change in terms of how it's used. Where it's going, we don't know, right? We don't know whether or not hybrid is here to stay forever. If you had to bet today, you'd bet it was, right. But it is here to stay. But we don't know some of the long-term ramifications of people. Are they able to get the promotions or the raises that they want? Do they feel as, connected to a company as those of their peers who are, in the office either full or most of the time? We don't know the answers to any of that. But as it stands today, people are not using office the way they used to. So as a result, there is less of a market for certain kinds of buildings. A buildings seem to be, Class A buildings tend to be doing better. B and C buildings, and particularly in certain markets, may be functionally obsolete at this point. So, even in the multifamily world, there's a difference there, because if you're a lender and you have both types of assets on your books, or loans for both kinds of assets on your books, the office asset is certainly something you don't ever want to take back, right? And by the same token, the borrower of that asset may just say, there's no point in my sticking with this asset, and I'm going to give you the keys, right? So that obviously is part of the context in which we move forward as an industry going forward, is that's what's happening in office. Multifamily is fundamentally healthy. What you're seeing right now is development, new deliveries that are really akin to what you saw in the 80s. And, you hear a lot of people talk about buying 80s value add. Well, the reason there's so much 80s value add, because there was a lot more apartments built
right
in the 80s. And if you go look, and we've looked at this sort of by decade, you'll see that right now we're getting new deliveries that are akin to what we saw back in the 80s. Well, that's, however, about to come to a screeching halt. And
why is that?
Because of interest rates and because of the cost of construction.
Mm-hmm.
So what is currently swinging hammers is going to get completed. And that, by our math, is going to take place over the next couple of years. However, depending upon the market, what we see is that by the beginning of 26, a lot of markets are going to flip the switch, and now you're going to have supply being outpaced by demand once again. And that's going to create upward pressure on rents. So, every market is obviously different. If you look at Austin and you look at projected vacancy, say in 2026, 27, it's still elevated. It's still 9%. Okay. Phoenix, possibly the same. On the other hand, if you look at markets like Denver, that's not the case. Even though Denver has a significant supply overhang right now, most of it, I think 25%, if I'm not mistaken, is in the downtown area. So you're not going to see that in certain suburbs. So Denver is a market that we are very, bullish on and continue to be. Dallas, if you look at absorption factor, right now, Dallas has got a lot of new supply. And so there's a lot of, softness in rents right now, but people are moving to Dallas. It's a very fundamentally strong economy. And people are still going there, and these units are being absorbed rapidly. So we believe that particularly in certain submarkets, you're going to see upward pressure on rents by 2026. And there's a handful of other markets where it's like that. So you have to be granular about it. Your research needs to be targeted to the individual market. Because certain markets just have had so much new supply. There's still going to be some pain starting, still moving on into 26. So I think, for our investors, we are going to be targeting markets where our research suggests the suburbs that we like or the submarkets that we like are going to move back into balance, or better yet, where demand is going to outpace supply.
What do you see happening in California? You mentioned you're still optimistic about that.
Right. Well, California is an interesting place. It's a euphemism, of course. So, California, if you think about it, has a differentiator. It has an economic moat, or it has a moat that none of the other 49 states have, and that's its climate. Climate change or otherwise, the fact is there is no other state with our climate. So it's sad that you see, the lagging economy, the lagging unemployment, meaning unemployment is still higher in California than it is nationally. This state could be a juggernaut in terms of if it created an environment for employers who want to be here, people who feel that they can live here, and the cost of living will not be as painful as it is for a lot of different people. So the fact that we live in an environment where all of this amazing resource, in this case, I'm referring specifically to our economy, but remember, there's also incredible university. I'm referring specifically to our climate here, or to the fact that it's sunny and beautiful so much of the time.
Right.
But also we have amazing universities. So we could be hands down, in a league of our own in terms of the quality of life for the people who live here if the state were run better.
Right.
And if the individual cities were run better. The flip side of that, though, is it's just so hard to build here for so many different reasons. Some of them are government policies, right? Meaning if you're going to have rent control in certain markets, you're not going to get the kind of new construction that creates more supply and brings rents down. If you are, and this is not all, you can't blame the politicians for all of it, right? Because there's also the NIMBYism that gets in the way of adding the kind of supply that is necessary for the size of our population. So what is the effect of that? Well, the effect of that is that as a landlord, you can keep your buildings full. There are headaches, the types of headaches that you get paid to deal with. And that's unfortunate. What's really unfortunate is the impact this has on the tenants, because they are hearing something that is untrue from our elected officials. If you go look at a building we own, brand new building in a suburb of Fort Worth, for $1,800, people get this beautiful, spanking new, highly amenitized unit, and of course the amenities around it, in our common areas. And you look at what they get here in Los Angeles, where the housing stock is so much older by and large. No wonder people are moving. So from the standpoint of supply and demand, the combination of NIMBYism and restraints on new construction, and those restraints could be just disincentives, right? Things like rent control, creates opportunities for a landlord, because you get a stability in terms of your occupancy, in terms of your rents. We wouldn't buy in Los Angeles. We wouldn't buy in San Jose. We wouldn't buy in Berkeley or Richmond. But there are other markets where even if you have statewide rent control, I mean, let's remember statewide rent control, while suboptimal, at least in California, is a lot fairer than it is, say, in New York, where, as it stands today, your rent increases are not, they're capped, but I would argue they're not unduly capped as they are in certain places.
Mhm.
And you have vacancy decontrol. So at least when you get a unit back, you have the opportunity to bring it to market. So you're not stuck as landlords in New York are. So again, I wouldn't buy in certain markets, but there are markets that we would buy in where, you look up in the Bay Area where people who, this is true for me. I grew up here in Los Angeles. I went to Berkeley, as I mentioned, and a lot of my friends who grew up here stayed up there because they like it. It's beautiful up there. San Francisco is one of our country's most gorgeous cities. I don't know that people are enjoying it as much right now because, there's a lot of quality of life impediments to enjoying its natural riches. But there are people who go to a Berkeley or a Stanford will oftentimes stay there and they want to form a business. So there are, and you have a good freeway system up there. We like to buy around the 680 corridor where you have access into we own in Pleasanton. You have access down into Fremont in 25 minutes off the 680, which is where Tesla's factory is. 10 minutes further down the road, you're in North San Jose. Cisco, Hewlett Packard, PayPal are all located there. So some of these East Bay markets are really well calculated or well placed, is a better word, for the this current hybrid lifestyle, because you can work hybrid. You can get to an office in the city or in, as I say, in Fremont or the South Bay by car. You have BART stations. So you have public transportation that makes it possible. So there's a lot of really compelling places to buy in California, and we plan on continuing to buy here. But we're going to spread it around because we think there are other places that have, in some cases, better stories. And we believe that diversifying the portfolio with some of the sort of the strong national markets is what's best for our investors.
Are you at all concerned? You mentioned about vacancy decontrol. As some of our listeners might know, that's basically made possible by Costa-Hawkins. And every couple of years, our friends over at the AHF put a bill on the ballot to basically get rid of Costa-Hawkins, and that'll permit local municipalities to basically take away vacancy decontrol. Is that something you're factoring into your investment decisions?
Always concerned about it. Yes, always concerned about it. I have a few thoughts on it. Number one, there's a lot of disrespect that I think that is paid to the average voter, and the average voter, certainly when it comes to, I think mostly by our elected leaders, but the average voter turns out to be a lot smarter than people give them credit for, and they've seen through the falsehoods and the false promises of false hope that Prop 10, Prop 21, these were those bills you were talking about, right, both offered them, and they resoundingly defeated those bills. Rent control is an interesting concept because it is one of very few areas that both the left and the right agree. That is to say, economists on both the left and the right agree that rent control is harmful to communities. It does not do what it's supposed to do. It does not bring rents down. It does not improve quality of life. It reduces quality of life. It reduces the quality of the housing stock that the citizens of a community live in. This is all well proven. You've got voices as prominent and as duly liberal as Paul Krugman, who wrote an article in 2008 against rent control. There's I think he was a socialist, Swedish economist, who said rent control is the fastest way to destroy a city other than bombing it. I'm paraphrasing. So this is not hard. This is not one of those areas where reasonable minds can differ. You can see it in other markets. You need to build more housing. You need to make it possible to build more. And, our city does suffer because it doesn't have some of the, the public transportation capabilities that, that other cities have had, because we didn't build underground at a time when it would have been easier to do so. So there are a lot more cars here. So, I'm sympathetic to it. But the fact of the matter is, if you live in Los Angeles and you rent, you are not as well off as you would be if you lived in Denver, if you lived in Texas, if you lived in Florida. And there's a lot of people in California who think ill of, let's use Dallas or Texas rather, or they think ill of Florida. But I'm going to tell you something. The people who are moving to these cities are not a bunch of right-wing extremists. These are people who may not like certain other, laws that that they have in some of these states, but their quality of life is so profoundly improved.
Yeah.
That they move there anyway. And so I think, over time you may see, some softening in some of these policies. I don't know. There's no reason for me to get into the political side of it other than to say that when you were talking about what it costs to buy a home, when you were talking about what it costs to rent, you were talking about a very critical issue for how people enjoy their lives. And this is an area where California is not serving its citizens well.
Right. And you're saying because of the rent control, it's an easy thing to sell. It's like opioids, right? Very easy to sell and very hard to take away once you've given it because it gets addictive.
That's right.
But fundamentally, like overdosing on opioids, it's very destructive. And I think people don't necessarily understand the economics of it. Because if you keep supply low and demand high, rents will go up, not down.
It's proven in all these other markets. And, we're seeing it, as I mentioned a few moments ago, in our buildings in Dallas. Rents are softer right now. They were going up dramatically. Now they're not. Why? There's new construction. It's easy to build there.
Right.
And I don't know a landlord who says, oh, I don't want to be in a place where it's easy to build. You factor that into your underwriting. You look at a market and you say, okay, well, I think, my concessions long-term need to be higher here in terms of what I'm underwriting, because I don't know some of these buildings are going to get built, but I know that that's what happens here and that it ebbs and flows in some of these different markets.
Right.
And, ultimately that redounds to the benefit of the people who live there.
But you're saying it's healthier for everyone involved, the landlord, the developer, the renter, to have easily accessible and easily buildable supply. Even if the rents are coming down a little bit, the landlords don't mind because they'll just say, we'll just build more buildings. Is that about it?
Yeah, we don't build, but yes. We only buy, so we only buy existing buildings. But yes, that's exactly what I'm saying. And you see it here in Los Angeles. There was a movie that came out on Apple Plus, I think it was, a few years ago, called The Banker. Two African-American entrepreneurs who ended up buying a ton of apartment buildings in Los Angeles. And I was watching it with my kids. And at one point, I pressed pause as they were driving down a street in Los Angeles. I said, what do you notice about this? They said, what? I said, those are buildings that was taped this today, or that was taped in the last 6 months. Those are the same buildings. This was 1955, I think it was. Those are the same buildings they can show today. They don't have to go to a set. They can drive down a street in Los Angeles and have the exact same buildings that these guys were buying then. So then I looked at, well, what was the population? The population in the city of Los Angeles was almost double what it was in that time. And you're still looking at the same 2-story motel-style buildings with, say, 14 units. And you have to improve the density here in Los Angeles. It's just critical to people.
And they're nearly impossible to maintain. And they're not built for strong rains. They're not built for any of the new stresses that buildings and that tenants put on these buildings.
Yeah. I don't necessarily think, we have good tenants. We have great managers. They take good care of our buildings. So I don't really think it's about the tenants as much as I think it is about deferred, I don't even want to use deferred maintenance. I think just buildings become obsolete. There's this concept of depreciation, right? Well, it's a fiction, right? It's an economic depreciation, but the actual physical depreciation You don't tend to see it as much, let's say 40 years old, buildings in the 80s and all that. You see it, but not as much. You start owning buildings in the 50s and the 60s, you do see issues when it comes to plumbing, things of that nature. Also, they're non-sprinklers, so you don't have you don't have some of the safety measures that you would want, and the cost of repairs is that much higher because it's constant.
Right.
There's always a plumbing. There's always a plumbing issue. So this isn't. I don't think this is controversial to say this. I don't think this is a left-right thing. That everybody agrees that you need to create an environment in which people can build more. And the problem is that I think people have an antagonism, and I suspect it goes back to feudal times towards landlords. And it's easy to beat up on a landlord. And there's a lot of landlords, and this is something that you've educated me on, who are not good landlords. And these are not who do not take care of their tenants. And I remember you said something to me, and I quote you all the time. Why does it upset me when I see a case that I know is fraudulent? And you said the reason is, Larry, because you take care of your tenants, and that's why you have so few of these problems. But not everybody does that. And so I understand that. I get that. But I think that our community tends to paint everybody with a brush that is contrary to their own best interest, because you'd be better off figuring out a way to create partnerships with landlords that do the things the community needs. And in this case, what the community needs is to build more, and I'll use the word affordable with a little a, housing.
Right. No, that's 100% true. Let's talk about management. I know that our experience was you were self-managing in California for a little while. You're not doing that anymore. Are you self-managing anywhere else, or are you completely out of the management game?
We manage our large buildings in California only. So our syndicated assets, we manage ourselves.
Okay.
We don't manage the out-of-state assets because we feel that since we don't buy just in one or two states, given our size, we might have two assets here and two assets there. We like the scale and what that brings of some of these other firms that we feel do a good job, and they eliminate some of the risks that we perceive. And those risks include if a maintenance person leaves, for example, a larger firm has sort of a next man or woman up. They can fill that spot, at least in theory, quicker. It's not as easy as it sounds. But
right, never is.
Easier. Whereas, if you only have two assets, it's a little harder. If you only have two assets, say the state of Washington. What we don't do typically, with one exception, and you never say never, but we typically don't use the large national firms. And again, this has evolved over time. Our preference has been to focus on, if we're using third-party management, strong regional players, people that still have an entrepreneurial spirit in them, and they have a lot of understanding predominantly in the market of Denver or the market of Seattle, for example. California, we manage our own buildings because, frankly, we've been doing it longer than anybody else, and we're good at it. We don't manage the LA buildings. There's a lot of reasons for that. One of them are some of the headaches that you see in Los Angeles. But also the other issue is that Los Angeles buildings tend to be smaller, ours are, than the large complexes we own nationwide. And that's true for most people. So for us, we would have, a manager who could be, say, a key holder. As software has gotten more complicated, for example, Yardi is a perfect example. This is a really, I'm sure they call it robust. I would call it complex.
Yeah.
A piece of software to use. And, some managers are unable to use it. And so that would tax the people who work at our corporate offices in terms of providing them with assistance, so on and so forth. So we felt that we moved to Moss, and so far we've been really pleased with them. I mean, nothing is perfect. I think one of the raps on when you work with a third party is then you blame every problem on them. Well, it's third party; they don't care, right? Because it's a mill. our experience has been, if you're honest, you go, okay, well, I could have had that problem too, right? If we were managing that building. Now, I'm not saying that's always the case, and there needs to be a close, sort of supervision. Supervision maybe is a little bit of a paternalistic word. I would say, or patronizing, I would say more, we just feel that it's necessary for us to treat all of our buildings as if we still manage them. And that is the level of sort of hands-on oversight that we apply to all the third-party managers we work with. And to their credit, they always seem to appreciate it. They certainly don't seem to resent it. You might think they would, but I think they don't. And I think the reason for that is because the bar is high. You give credit where it's due. You say thank you for a job well done. And so if you're also saying, hey, look, something's not right, I think they feel like, wow, that maybe this is something we need to take a look at.
Okay, that's great to hear. We're pretty much at an hour right now, Larry. This has been great and amazing. You provided our listeners with a lot of really good insight, and I hope it will help them in their real estate adventures and journeys and figuring out, how to make it in this business, which is just never been easy, and I don't think it's still easy. So thank you so much. I really appreciate it.
Pleasure. Always a pleasure to speak with you, Niv. I appreciate it. Appreciate all you do for us.
Not a problem. We're always happy to provide the service. So I thank everybody for tuning into this third episode of Landlords and Tenants. I hope you had as much fun as we did. Please tune into our next episodes, which are coming soon. Of course, if you have any questions about landlord-tenant matters, real estate, or construction, please feel free to reach out to us. Our telephone number is 818-661-2420, or you can email me directly at niv@davidovichLaw.com. That is David, OVICHLEW.com. Thanks so much. See you all again soon.
But I think the most touching question is, why did the war stop?
You've been tuning into Landlords and Tenants with your host, Niv Davidovich. You can find the show on all the major platforms, including YouTube, LinkedIn, Facebook, Apple Podcasts, Spotify, and on our website, DavidovicLaw.com. Thank you for your positive reviews, comments, questions, and for sharing this show with others.